So welcome again to Accounting with Madam Wombi. Today we are going to be looking at introductory accounts of a partnership, rather an introduction to partnership accounts. Now to start with, we are going to define what is a partnership. Now a partnership is an agreement between two or more persons who come together to carry out business with a common aim of making and sharing profits. That is simple. Two or more people come together, they have one intention: to do business and to share the proceeds from the business. So that is a partnership definition in form of a business. Now when these two people come together, ultimately and most important, the first thing they have to do is to form something that we call a partnership agreement or a partnership deed. So that brings us to the second item here. What is a partnership agreement or a partnership deed? This is an agreement in writing amongst the partners that is going to stipulate the terms and conditions of the partnership business. That is, what are the rules that are going to be governing their operations? They have to agree. It is very important that they agree and they put it in writing so that in future, when they have disputes, they can be able to refer to this partnership agreement or partnership deed. Now, what are the provisions that have to be there? What do they have to put in the partnership deed? These are the provisions that they need to put in the partnership agreement. Number one, they have to agree on the name and the address of both the firm and the partners themselves. So definitely in the naming of a business, because the business is going to be separate, distinct and distinguished from the owners, according to the business entity assumption, they have to give the business its own name. As much as they are the owners, the business will have its own name and address. Of course, the name would be anything they agree on. The next item they have to agree upon is the capital to be contributed by each partner. It is not a must that the partners contribute in equal amounts. The partners may contribute differently, so therefore they agree on how much each partner is going to contribute. Number three, we have to agree on the profit and loss sharing ratios. Again, this may be dependent on their capital contribution, or it may also be dependent on the type of partners. Some partners contribute money, but they are not involved in the business, day-to-day management of the business. Therefore, they may have a less share in the profits. Otherwise, we are saying this is the agreement. However, they agree to share profits. That is why it is up to them. So profit sharing ratio is another item they have to agree on. The next one is interest on capital. They have to agree on the interest to be paid on capital. It is not mandatory, but they may decide as a reward for the money invested, each partner is going to receive a certain percentage as an interest on capital. They may agree that if you contributed 100,000, for example, every year you're going to be getting 10%, which is going to be 10,000 as interest on your capital. This is different from the profit from the business. Interest on capital is just a reward on your capital that you have invested. So they have to agree. We are saying it's not mandatory whether there will be interest on capital, and if it is there, how much is it going to be? The next one, they have to agree on drawings. Are the partners allowed to withdraw any money or take any goods from the partnership business? If they are allowed to take any goods or any money in form of withdrawal, then it has to be agreed upon how much is the maximum drawings, and if they will be charged an interest on the drawings. That is, for example, they can say, for any amount taken over by the partners from the business, the partner shall pay an interest on that amount, let's say maybe 5%. So that if a partner withdraws 100,000, he's going to pay to the partnership business 5%, which is going to be 5,000 to the partnership as interest. So interest on drawings is paid by the partners for any money that they withdraw or any goods they take over for personal use. Again, the next item they have to agree on is the salary to be paid to the partners. Now, not all partners can be entitled to a salary, but those who are involved in active day-to-day management of the business, definitely they are going to demand a salary. So they have to agree in writing how much is the salary to be paid to those partners who are involved in day-to-day running of the business. Those are the active partners. Finally, they have to agree on the procedure for admission and retirement of a partner. At the point of exit or in case of death of a partner, what procedures shall be followed? They have to agree on that. In case they need more capital and have to bring one more partner or two on board, what is the procedure for admission of a partner? So these are the items that they have to agree on in the partnership agreement. It is good to note that if they fail to develop a partnership agreement, they shall be governed by the Partnership Act. In Kenya, that is Cap 29 of the Partnership Act. They have to be governed by it and all the provisions in the Act. That is as per the laws. Now, that is just a brief discussion on what is a partnership. Our main interest in accounting is how to account for the partnership business. So these are the accounts that a partnership business has to prepare. The first account is the income statement. Income statement, it is the trading profit and loss account. Despite here being a partnership, this account is prepared the same way as that of a sole proprietorship. It is prepared the same way we prepared of a sole proprietorship, with the assumption that the affairs of the owner and the affairs of the business are separate. Therefore, we prepare an income statement for the business. And now, on the issues about the partners that we have mentioned here, the issues of salaries to partners, interest on capital, interest on drawings, those are their personal affairs. Those personal affairs shall be brought to the appropriation account. It comes from the word appropriate or share. So in that account, they are going to be looking at how to share the proceeds from the partnership, taking into consideration the items stipulated in the agreement that we have mentioned. Now, they're also going to prepare a capital account. I am assuming here their capital account is a fixed capital account, where it is represents the long-term interest in the partnership. It does not include the short-term interest. It only focuses on the permanent interest, or what you call the long-term interest. That is the capital. For all other issues that keep on fluctuating from the trading account from one period to another, like the interest on drawings, capital interest, interest on capital, salaries, those are normal. They keep on fluctuating from year to year. They result from the normal operations. Those ones, we are going to post them in the current account, or what we call the fluctuating capital account. The reason it's called fluctuating is because it's changing from year to year. Finally, they are going to prepare the statement of financial position. Now, one by one, we are going to look at what is incorporated in these accounts. So, we are going to start with the income statement. Now, for the income statement, it's good that you note that it is prepared the same way as that of a sole proprietorship. So, we can start and say that it is prepared the same way as that of a sole proprietorship, that is, other businesses. I will not explain this in this video because I've already done a video that explains this concept. It explains how you prepare the financial statements of a sole proprietor, and this format is the one that is used. So, if you do not know how to prepare the income statement, refer to that video that talks about how to prepare financial statements of a sole proprietor. Now, just a quick explanation. An income statement helps us to know whether we are making a profit or loss. So we begin with the amount of sales, how much was sold during the year. We less any returns, anything or any sales that were made were returned by the customers, therefore getting the net sales. We subtract the cost of sales. The cost of sales represents the amount of money that was spent by the proprietor on buying the stock, bringing the stock to the facility where they are going to be sold, and finally selling them. So this represents the cost of sales. Finally, you add other after which you get the gross profit. And the gross profit, you add other incomes. Finally, you less expenses, as you can see there. You less expenses, and you're able to get either whether you're making a net profit or a net loss. So this I've said is explained in another video. Kindly refer to that video. So you're going to move to the next account, which now is called the appropriation account. An appropriation account, as I've mentioned, is where the partners share the profit. So once the business profit has been computed, it is the beginning point. So we start with net profit for the year. This is the beginning point. The beginning point here we are saying is the net profit for the year. Once we have the net profit, we request the partners, if you withdrew any money or if you took any withdrawals, kindly bring the money, which is the interest on the drawings, not the drawing itself, but the interest on that money. The interest on that money is a revenue or is an income to the partners, as much as they are the ones that are paying it, because they are the ones who took the goods. We are going to add it to the profit before we share the profit. So the partners bring in the interest on drawings. Any money that they had taken over, the interest on that money, as per the agreement, they bring that money and we add to the net profit. So you can find here that the interest on drawings is added. From there, it shows that you add to the net profit. So again, the partners agree that if any partner is entitled to interest on capital, let's pay the interest on capital to the partners from this money that was made from the business before we share the profit. So again, we less the interest on capital. Each partner contributed capital. They are being given a reward for their capital at a certain percentage, so they are given the interest on capital. This one we are subtracting because we are paying. As the accountant, you are the accountant. You are going to subtract the interest on capital for each partner so that you know how much money remains. If any partner is entitled to a salary, we also less the salaries to the partners and pay them. So you pay the partners and you subtract the money from the profits. So whatever remains is what we call the profit to be shared. And finally, you share that profit among the partners in their ratios. Here it does not have to be equally, it is according to their agreement, however they decided to share the profit. So this is simple. It is simply what you're calling the appropriation account. It is simply the net profit, you add the interest on the drawings, you less the interest on the capitals that are paid to the partners, you less the salaries to the partners, because each one of them receives something different from the other, as we are going to see in our question. That gives us a profit to be shared, and finally you share the profit and nothing is left, because once you share the profit, the remaining amount is shared, nothing is left. So the balance of this account is going to be zero. It's going to be nil. Now, once you have done this, these three items here in the interest on drawings, the interest on capital, and the salaries, they have to be posted to the current account. So this brings us, let me first of all show you the current account. This brings us to this current account, or what you call fluctuating account. Now, this account, we have posted here some balances brought down. These are the balances at the beginning of the year. I would like to note that it is not a must that a partner's balance is on the credit side. It could also be that the partner's balance is on the debit side. That is possible for this account. It depends on how much the partner has from the fluctuating operations of the business. Did he receive more or did he pay more during a certain period? So assuming that they all have positive balances whereby they have something in their current account, anything that was given to them during the year, anything that they received during the year shall be credited to this account. And what did the partners receive? We have said partners receive number one, salaries. So once they are paid the salaries from the appropriation account, we are going to credit to this account. We have also said partners are given interest on capital. They receive interest on capital. Anything they receive, you credit. So they are going to be receiving interest on capital, you credit to this account. They are also going to be receiving a share of profit, which you are also going to credit to this account. So anything that partners receive, we are going to credit to this account. Anything that partners receive, we are going to credit to this account. Now on the other flip side, that is on the debit side, anything that the partners pay or have to pay or have taken over, including losses, it is going to be debited to the account. So they took over some drawings, that is the money they withdrew or the goods they took over, we are going to debit. This represents an outflow. On this side, it represents an inflow for the partners. So they took over drawings, we are going to debit to this account. They have to pay interest on those drawings, we are going to debit to this account. In case there was a share of losses, whereby instead of gaining a profit, they made a loss, it would also be debited to this account, from which now we are going to compute the balance carried down. Again, the balance carried down depending on whether you received more than you paid, or you paid more than you received, the balance carried down would be on either side of this account, depending on your situation that year, in terms of how much you took over and how much you received and how much you paid or how much you took over from the business. This is the current account. Now, going back a little bit, I am going to explain the capital account. This one needs not much explanation. We are assuming the capital account is a fixed account, whereby it only has the money they initially put into the business. So this one, so it is how much they put into the business at the beginning of the period. So the balances brought down here shall always be on the credit side, because this is the money they brought into the business, you carry down from one year to the other. This account does not change. It is a fixed account. It only changes in certain circumstances, two of them. Number one, if the partners decide to bring in additional capital. So, when the partners decide to bring in additional capital, through the bank, of course, that's why I've written here bank. So, the partners have decided to bring in additional capital through the bank, we are going to credit to this account. But if a partner dies, permanently withdraws from the business and takes over their capital, we are going to debit this account that they have permanently withdrawn from the partnership. So those are the two circumstances. You either bring in additional capital, which is going to be credited to this account, or you permanently withdraw your capital, which is now going to be debited to this account. So otherwise, this account does not keep on changing. It is a fixed account, which you are calling the capital account. So the final account that the partners have to prepare is what we call a statement of financial position. Again, this account has been explained in the tutorial where I explained how to prepare a balance sheet. It is prepared the same way as that of a sole trader, and I'm going to try to show it. The only differences are very small. So a statement of financial position, it tries to explain how much is the worth of the business, or how much does the business have in terms of net worth. So we are going to start with the PPE. There stands for plant, property, and equipment for all assets. That is all the fixed assets or all the non-current assets. We are going to have the year costs. their accumulated depreciation. Quickly, we are going to come to all the current assets that the business has, as represented there. We are going to less the current liabilities, and we are going to get the net assets. So this part does not change. Kindly refer to that video where I've explained financial statements, because it is the same way that we prepare as that of a sole proprietorship. The only difference in a partnership is going to be here on the financed by section. So beginning here is where the difference is going to be on the financed by section. So in a partnership is financed by capital of both the partners. We also bring in the balance as per the current account. So we first of all draw the current account and see how much did the partners have at the end of the period. Once we know how much they have at the end of the period, those balances are the ones that we are going to bring here, which are from the current account. And of course, in case this is not enough, they may have taken a loan. We also have to bring the loan, the long-term loans. So I'm saying that the only difference between a balance sheet of a sole proprietor and a partnership is this part, the financed by section. Otherwise, the rest is the same. So having explained that, it would be only good that we see this in a question. So we are going to try to answer this question. We are going to do the question as follows. So the question says that Apex and Blair are in a partnership, sharing profits and losses in the ratio of 3:2, respectively. After crediting the account with the interest on capital at 10% per annum. So the first thing we're going to compute is the interest on capital. So allow me to use A to represent Apex, A to represent Apex, and B to represent Blair. So each one of them is getting 10% interest on capital. So this is 10%, 10%, multiply with your capital balances. So from the trial balance that you're given there in the question, you will find that their capital balances is 500,000 and 400 respectively. So 500,000 and 400,000 respectively. So 10% of this amount, this is going to be 50,000 and this is going to be 40,000. So we can continue the question. The question also says that they are entitled to annual salaries of shillings 15,000 and 20,000 respectively. So salaries, here we need not compute anything. We just need to note down that they are entitled to salaries of 15,000 and 20,000 respectively. 15,000 and 20,000 respectively. The next point says that interest on drawings is to be charged at 5%. So interest on drawings, we are going to compute. It is going to be 5% of the amount with the drawing, or multiplied by the drawing. So we are going to multiply this with the drawing amount. So the drawing is that Apex has withdrawn 225,000, while Blair has withdrawn 215,000. So they are going to pay each one of them 5%, 5% on the drawings. Okay, so the interest on drawings is going to be computed as 5% of the drawings amount. So from our question, which I hope now you have made a copy of so that you are able to follow, because I'm not able to display the question as I work on the whiteboard. 5% of these figures is going to be 11,250. 11,250. while the 5% of this is going to be 10,750. Those are the additional information you have been told in our question. Quickly, without wasting much time, now we are going to prepare the appropriation account. You realize that our trial balance does not require us to prepare the income statement. The income statement has been prepared already. What we have there, we are starting with a net profit. If the income statement was not prepared, we would see the sales, the expenses, we would see even all those issues that are usually in the income statement. So I will put on a new tab where we are going to do the appropriation account. So appropriation account, we have said that it is going to have two columns. We are going to begin with net profit. So we are going to start with net profit. The net profit we are given in our question is 800,000. So we are saying that there are three things affecting this appropriation account. First of all is the interest on drawings. The partners are not receiving interest on drawings. They are the ones who are bringing in interest on drawings. They are the ones that are being charged interest on drawings. Therefore, we add. So they are bringing in the interest on the money that they had taken over. We add to this profit. Then we are going to share those proceeds among them. So interest on drawings, which we have computed A and B, we have computed in our previous working that we have there. From the previous, you can be able to see here the interest on drawings as we have computed it. It is 11,250 and 10,750. So going back, our interest on drawings is going to be 11,250 and 10,750. $11,250 and 10,750, like that, giving us a total of 22,000. Giving us a total of 22,000, and we are adding that figure. So the next item we are going to less is the salaries to the partners. So we less salaries to the partners. That is A and B. The salaries to the partners we had been told was going to be 15,000 and 20,000. So one partner has 15, the other one has 20,000, giving us a total of 35. So we are paying them from this money that is there. We are also going to pay the partners interest on drawings. So again we less interest on drawings. So the interest on drawings that we are lessing, we are going to have interest on capital, interest on capital. So we are paying the partners their interest on capital. We have A and B. Again, this one we did in our previous working. You can refer to the working that we have done just previously. The interest on capital is going to be 50,000 and 40,000. Giving us a total of 90,000. We are lessing, so when we less, you put in bracket. Now, the addition of this 800 plus 22 minus 35 minus 90 gives us the profit to be shared. Profit to be shared. It is going to be 697,000. Then you're going to share that profit among the partners in their profit sharing ratio. A is going to get 3/5 as per the agreement, while B is going to get 2/5. So you multiply with that amount. And you're going to get 418,200, and this one is going to be 278,800, and that will offset the whole of this balance, leaving us with 0 or nothing. So this is going to be the appropriation account. So quickly, let us post these items to the current account, because you said the second thing is the current account. So the current account, we can have it here. This is going to be the current account. Beginning with the balances that we have. Beginning with the question, the balances of the current account we have there is, okay, so we are going to have a column for details. We are going to have A and B. I am ignoring the column for the date. So we are ignoring the column for the date. So we are going to start with the opening balances. In our question, the balances we have there is the current account is 20,000 and 10,000 respectively. And they are on the credit side. So we are going to start with credit balances. Remember we said this account, the balances can be on either side. So these ones are credit because they are credited in our question in the trial balance. So we have 20,000, 10,000. Anything that the partners receive, we are going to credit this account. What have we seen? From the appropriation, here, partners are going to receive salaries. Partners are going to receive interest on capital. Partners are going to receive the profit share. These are the items you are going to be giving them here in the current account. So we are going to give them anything they receive. They are going to receive salaries. They are going to receive interest on capital. And they are going to receive share of profit. So for the salaries, they are going to receive, we have seen there that the salaries is 15,000 and the salary is 20,000. For the interest on capital, you have 50 and you have 40,000. For the share of profit, we got 418,200 and 278,800. These are the amounts that anything they are going to receive, we have credited to this account. Anything they are going to be paying or anything they have taken is drawings. They are going to pay the drawings. Again, you have the column for the details and for the partners A and B. So drawings, previously in the appropriation account, we can see that there was no drawings here. Only thing we had here is interest on drawings. So drawings is the only item that is not in the appropriation account, but it is in the current account. So going back to our current account, drawings have to be paid by the partners from what they have received during the year. Whatever they withdrew, they have to pay. Therefore, we are going to debit the drawings. The drawings is going to be 225,000 and the other one is 215,000. Then they are going to pay interest on drawings. Interest on drawings. So the interest on drawings, we are going to have 11,250 and 10,750. So this is our current account. But now we do not leave the account like that. We have to balance. By balancing, we mean see how much the partner has or has received against how much they have paid or have to pay and get a balance. Now, if you add this column for A, the total amount received by the partner, total of this column is 503,200. And they are paying these two. They are paying 225 and they are paying 11,250. So therefore they have a balance carried down. How much is left? From 503,200, you less these two figures. You get the balance carried down here is 266,950. Therefore the total again this side now is going to be 503,200. You do the same for the other partner. You add how much they have received from the partnership. They have received 348,800. That is how much they have received. You less these two, which is what they are paying, and you see that the partner is left with a balance of 123,050, giving us now the total for both sides to be 348,800. So that is the partner's current account, which is the second account they have to prepare now. Finally, we are going to draw a balance sheet or a statement of financial position. So I'm going to add, so a statement of financial position, you are going to get it from our question. I'm going to shorten here, you have just the statement of financial position. We have the cost of the assets, we have the accumulated depreciation, and you have the net book value. Starting with, we are going to start with the non-current, or what we call the fixed assets. So the fixed assets, the non-current assets, we are going to start with the year costs. So from our question, the cost of the non-current assets in total, you are given in total, is 1 million. And they have an accumulated depreciation of 200,000, which we are going to less. So we are going to say 1 million minus 200,000, we are going to get the net book value as 800,000. Then you are going to come to the current assets. Current assets. This one we underline because there are several of them. Our current assets are those items that are consumable, sellable, or easily convertible into cash within a period of 1 year. So from our question, we have debtors. We have debtors. We have inventory. We have cash. Those are our assets. We are going to use the middle column to show them. That is this middle column. So for debtors, we have 100,000. For inventory, we have 200,000. And for cash, we have 290,000. We are going to get a total of the current assets, which is going to be 590. Okay. Then we are going to come to current liabilities. Current liabilities. These are obligations that are payable within a period of 1 year. And in our question, we only have one. We only have creditors. So we are going to put here creditors. We are going to less that figure because it's only one directly from this column because we only have creditors. If we had many of them, we would align them here in the first column and then get the total and bring the total under the current assets. But now we only have one, so no need to put in the first column. So bring it just to the second column and less. The creditors here is 100,000. So the difference between the current assets and current liability, the difference is called working capital. The working capital is going to be brought to this column, which is now 490,000, which we are going to add to that net book value to get the net assets. The net assets is 1290, that is 1,290,000. And we are saying this is called the net assets. So we have to show here now, financed by what? Where did we get this wealth from? So we have to show the financed by section. And we said for a partnership, it is financed by two things. That is the capital of the partners. A and B, they have to be represented individually. The interest of every partner in the business has to be represented individually. So capital from our trial balance, we have 500,000 and 400,000. Then you have current account, current, which again we are going to represent for A and B individually. Now, we have to go back, previous, come here. These are the balances of the capital account, current account. If the balance carried down here, the balance brought down is going to be here. This balance is carried down, the balance brought down is going to be here. And these are the balances we are going to take to the balance sheet. These two balances. And they are credit balances, meaning they are positive, because the balance brought down is on the credit side. And we know that capital account has credit balances. So in our balance sheet, we are going to bring in those balances here, which is 266, 950, and 123, 050. When you add this, it should give you 1,290,000, which is the capital employed. Capital employed. Now, if the amount was not equal to this amount, it would mean they have an uncurrent liability, they have a loan. So we would add the loan here as was shown in the format. So that is how we do accounting for partnership. That is introduction to accounting for partnership. I hope you enjoyed, you have learned, and if you liked it, kindly share the video, subscribe. Thank you.